All right, welcome back to class, everyone. Today, we're diving into a really crucial explainer. We are finally making our way to the absolute bottom line. We're going to explore the exceptions of business operations, those irregular events that just randomly pop up, and look at how we ultimately close the books to figure out if a company actually made money. As future accountants, determining that final business result is going to be one of your absolute most critical responsibilities. Here is a quick look at our roadmap for Chapter 4 today: the nature of other activities, disposal and sale of fixed assets, penalties and reversals, closing to account 911, and we'll wrap it all up with some practice exercises. Let's get right into it. Section 1, the nature of other activities. So, what exactly makes a business activity other compared to just, our day-to-day operations? Now, a super common stumbling block for students is mixing up financial activities with these other activities. Think about account 515, financial income. This is your regular planned stuff, like bank deposit interest. But then look at account 711, other income. This bucket is for the irregular, totally non-periodic events, like earning interest every month. That's a planned financial strategy. But randomly selling off a broken piece of machinery, that is definitely an other activity. And here is the absolute golden rule you have to remember. The economic substance of a transaction dictates the account, not its legal form or whatever label is slapped on it. It literally doesn't matter what a contract is called. As accountants, we care about the underlying economic reality. Keep that in the back of your mind for every single journal entry we do today. So for these irregular events, we use account 711 for other income and account 811 for other expenses. But here's the kicker. Both of these are strictly temporary buckets. They carry zero closing balance. Basically, throughout the period, they catch random things like asset disposals or penalties. But at the very end of the accounting period, they have to be completely emptied out. Every single thing gets transferred over to account 911. Moving on to section 2, disposal and sale of fixed assets. Let's actually apply these temporary buckets to a scenario you'll see all the time in the real world: getting rid of old machinery. When a machine permanently breaks down, we have to follow 3 strict steps. First up, derecognize the asset. We debit accumulated depreciation in account 214, debit the remaining value to our other expense, account 811, and credit the historical cost out of account 211. Step 2, if we have to pay a crew to dismantle it, that cost is also a debit to 811. And finally, step 3, if we manage to sell off the scrap metal, those proceeds, they get credited right into our other income, account 711. You might be wondering, why do we record that remaining net book value as an expense in 811? Well, because it's an unrecovered investment. It's a very real economic loss. Think about it. If we bought a machine for $200 million, but only depreciated $160 million before it died on us, that leftover $40 million is money we never recouped. The business just didn't get the full value out of it. This perfectly highlights the difference between simply disposing of a broken asset versus actually selling a functional one. With a disposal, the asset is trashed. We just sell it for scrap, and there's no VAT invoice. But a sale? The asset still works, we sell it to an outside party, we issue a proper VAT invoice, usually 10%, and we record that VAT payable. In both scenarios, the income still hits account 711, but the tax compliance is totally different. All right, section 3, contract penalties and provision reversals. Let's see how our 711 and 811 buckets handle these specific oddities. Because let's face it, business doesn't always go according to plan. If a supplier is late and pays us a penalty, boom, unexpected economic benefit. We credit account 711. If we mess up and breach a contract, we debit account 811. But pay close attention to that last bullet: reversing a provision. Say we set aside $50 million for a product warranty last year, but only spent $35 million. We reverse that extra $15 million. Reversing a provision is not sales revenue, guys. It's just recovering an expense we didn't end up needing, so it naturally gets credited to account 711. Which brings us to section 4, the funnel, closing to account 901. Anomalies are sorted, so let's figure out our final results. I want you to visualize account 911 as this massive funnel at the end of the month or year. All our expenses, cost of goods sold, selling expenses, and those other expenses from 811 just get dumped right into the debit side. At the same time, all our revenues, net sales in 511, financial income in 515, and other income in 711 flow directly into the credit side. It's basically a showdown between the debits and credits to see if we survived the period. To fill that funnel, we follow 9 precise closing steps. We systematically transfer over our revenue deductions, net revenue, financial income, other income, and then the expenses. We take a quick pause at step 6 to determine our profit before tax. If we're in the green, we record the corporate income tax, transfer that, and finally transfer the ultimate result. And remember, class, these are purely accounting entries. There's no actual cash changing hands here. We're literally just moving numbers between buckets to calculate our final grade. The two VIP accounts at the very end of this whole process are account 821 for our corporate income tax expense, usually calculated at a 20% rate on our profit before tax, and account 421. Once account 911 has collected every last drop and the tax is deducted, our ultimate pass or fail grade sits right there in account 421, undistributed profit after tax. A credit balance means we won. A debit balance means we took a loss. To put that into perspective, let's look at the comprehensive example from our sources for Hong Leong Joint Stock Company. After funneling $2.49 billion in total revenues and deducting $1.92 billion in total expenses, they hit a profit before tax of $570 million. After slicing off that 20% tax, they are left with exactly this number, a profit after tax of 456 million VND. That right there is the number that transfers to account 421 to officially close out the year. All right, section 5, practice exercises. Let's put this into practice and see if you can think like a chief accountant with a few rapid-fire scenarios. Scenario 1. Imagine Salviat Company, a mechanical manufacturing firm, is selling off an old CNC lathe. The machine cost $800 million. They've already depreciated $600 million, and they're selling it for $250 million. First question for you. Which revenue account should capture this sale? Normal revenue account 511 or other income account 711? If you guess 711, you hit the nail on the head. Because it's a fixed asset and not their actual core inventory that they manufacture to sell, it bypasses normal revenue and goes straight to other income. We derecognize the $200 million net book value into account 811, record the $250 million sale into 711, and boom, we've got a clean $50 million gain. Okay, next scenario. Company ABC has an outstanding payable of $45 million to a supplier, but out of nowhere, that supplier dissolves. They just vanish, and the statute of limitations to collect the debt completely expires. What on earth do you do with that lingering liability? You write it off. You debit account 331 to clear out the payable, and you credit account 711. Why? Well, getting out of a $45 million debt legally is a very real economic benefit. You essentially just made $45 million by not having to pay it. This is a perfect example of what we talked about earlier, economic substance over legal form. Last one, let's look at the funnel. It's year-end, and your account 911 debit side, your expenses, totals $3.2 billion. But your credit side, your revenues, is only sitting at $2.9 billion. The million-dollar question: do you owe the taxman any corporate income tax? Absolutely not. Your expenses clearly exceeded your revenues, which means you have a $300 million loss. We debit account 4212 and credit 911 to close the funnel out. No profit means no taxable income. But hey, silver lining here. Tax laws actually allow you to carry this loss forward for up to 5 years. You can use it to offset future profits, which will definitely lower your tax burden when the business bounces back. As we wrap up this explainer, I want you to really chew on this fundamental question as you head into your future careers. As accountants, are we merely following legal forms, or are we truly capturing the economic reality of the business? Whether you're dealing with an asset disposal, a written-off debt, or a brutal year-end loss, mastering these entries means you are mastering the true story of the business. All right, thanks for joining me for this session, class. Keep studying, and I'll catch you in the next explainer.